I was taught by Graham Stephan to always make my iced coffee at home. So that's what I do. And I took it one step further. I make my own creamer. Boom. Boom. He would be so proud of me. I love Graham Stephan. Shout out. I don't know him at all. He seems really cool on YouTube. If you haven't watched his channel, I suggest running over there. He has 2, I think. So that's a free plug for Graham Stephan. But today I want to talk about what exactly is all wrapped in a mortgage payment, because after the last video of, okay, what is the first step in buying a home, which we all know now is save, save, save. As much as you can, save, save, save. But when you feel like you're mentally and emotionally and financially ready, you're gonna go and talk to a lender. There are 4 items that are all wrapped up into your mortgage payment that you are gonna be paying every month. And real estate agents, investors, and lenders all know this acronym to be PITI. P-I-T-I. All 4 of those together are going to be what is involved within your mortgage payment every month. So, number 1, P stands for principal on the mortgage. So, when you go and you find your dream house, and let's say it's $400,000, and let's also say you're in an FHA loan and are gonna pay 3.5% down. That's $14,000 that you're gonna take off on your mortgage. So your loan amount ends up being $386,000. Jessica, how did you come to that calculation? Okay, you've got $400,000. You are paying down 3.5%. So 400,000 times 0.035 is going to give you $14,000 that you're paying down. 400,000 minus 14,000 is going to give you 386. And that is going to be the principal that you are going to owe the bank throughout the loan's lifetime. Next in the acronym is I, stands for interest rate. This is just the rate at which you're paying the bank back. If you are in a conventional loan, there's incentives that come along with this. So the higher your credit score, the lower your interest rate is going to be. The higher the credit score, the less risk the bank sees you as. They're not going to think you're prone to defaulting on the loan, so they're not going to charge you as much because they think you're eventually going to pay off the whole thing. This is not true in an FHA loan. If you're in an FHA loan, it does not matter if you have an 800 credit score or a 620. Once you're in the door with FHA, you're all getting the same interest rate. There's no incentives with that. If you're interested in kind of playing around with like, okay, well, what if I had a 3.5% or 4.5%, like what would that ultimately do to my mortgage payment? I created a free estimated mortgage calculator. So if you want that, just shoot me an email, homeagain@jessicadorsey.com, and I'll send that your way. Totally free, super fun, I think, to kind of play around with, all right, what if I hit the jackpot and want to get this priced home at this interest rate with this down payment? It lets you know what you're going to be paying every month and ultimately what you would be paying over your loan amount years. The T in PITI stands for taxes. All taxation is theft, but who am I to say that? With your taxes, these are going to be based off of the assessed value of your home. So an assessor comes out and they kind of see what they think your home is worth, and they're going to tax you based on that. So the property taxes go towards infrastructure. The firemen, the policemen, schools, all of that stuff is coming from property taxes, essentially. Taxes, you're technically paying into them every month, but you are only paying them 2 times a year. So what happens is, as you're paying your mortgage, the portion that is being taken out for your taxes is getting dumped over into escrow. And they are going to hold that until it's time to pay the taxes, which is typically 2 times a year. So they're not messing with your money, they're not doing anything with it, but they're holding it for you so that they can pay the proper municipality when the time comes. The last I in PITI stands for insurance. And you've got two types here. You've got a homeowner's insurance, which is just your typical, a tree fell on the house and now I need a new roof and windows and whatnot. And then if you have not paid 20% down, this is where your private mortgage insurance is going to come in. Which this is the sticking point for some people, because the Dave Ramsey group wants you to wait until you get at least 20% down or cash so that you're not paying this. But to me, that means you're wasting a lot of time paying your landlord renting and making them wealthy and letting their property values go up instead of working on your own wealth here. So to me, the little amount that that PMI is going to end up being is not worth continuing to rent. So keep that in mind. Everybody is going to have a different thought on that. Do your own research, talk to your lender, and see if that makes sense for you to keep renting. If you're in the process of trying to buy, I would not rush that process. Still save as much as you can. The PMI is not going to go towards your paying down your principal at all. It is just an additional fee that does not help you at all. It only helps the bank. They are going to see you not putting 20% down as being at high risk for default. So they're going to want to take out some insurance on you in case you were to go into foreclosure or something like that. Then they essentially get paid back for what you didn't pay. If you are in a conventional loan, which I'll have another video that goes into some more differences between FHA and conventional, and there's a few other loans out there, but those two are the top residential loans. If you're in a conventional loan, you do have the opportunity to pay off your PMI. Once your home reaches 80% value with your loan, you can pay that off. If you're in an FHA, that mortgage insurance is until the end of the time with the loan. You could be in a 30-year fixed and 5 months from completely paying off your house, and you will still be paying mortgage insurance. Essentially, the government trusts you zero amount, so they see you at a high risk, and you're going to just keep paying that. It's one of the trade-offs with FHA, unfortunately. You can go into an FHA with 3.5% down, but you're always going to pay the mortgage insurance. So you just kind of have to decide what's right for you. So I did also want to chat really fast about, I know this was kind of a faster video, but about being house poor. I never want my buyers to end up buying a house that they really just cannot afford and maybe shouldn't be in financially. So you need to be super honest with yourself about what you can actually afford. What you can qualify for and what you can afford are two different things. So let's say the way that they figure out like what you can qualify for, what your monthly payment would be, they're going to take your income per month and they're going to times it by 0.5 or 0.56 if you're in FHA to get your amount. So let's say here that you make $4,000 a month. I got my little calculator. Make $4,000 a month. We're just going to go conventional. 0.5 is $2,000. 1,000 is what you have before they subtract all of your debts. So if you have a car payment or something like that, they're going to take that out. So let's just say you have $200 in payments that you have to make every month. So you technically qualify for $1,800 in monthly payments. Now, do you want to pay $1,800 a month in monthly payments? I would say no, you do not. There's different rules of thought here with how much you should be paying for your living expenses. 50%, if you get above 50%, you are considered house poor. That means that more than 50% of your monthly income is only going to pay the house. You're not paying food, you're not paying your car payment, you're not, hopefully you don't have a car payment, but maybe you do. Nothing on investments, no phone bills, 50% is just your house. And that's a little crazy. The general rule, according to CNBC, is that no more than 30% of your monthly income is going towards your housing costs. So with ownership, that's your mortgage and your maintenance and any other like property tax stuff that you have. 30%. So if you're making $4,000 a month times 30%, you really want to keep that at $1,200. And that's like the top. Ideally, you want to be below that. So that's also just something that you need to think about when you're starting on this home buying journey of what you can actually afford, and be honest with yourself. The reality is your first home is most likely not going to be your forever home. So if it's not everything that you wanted, you need to think of it in more of an investor mindset of, okay, right now it's just me and my other person here, or it's just me by myself at this journey. If you have a little family, great, that's what you are now. If you see yourself needing something in 5 years, but this will suffice for 2 to 3, I would suggest that you think about still buying, because not only are your values going to increase, but you are then going to be gaining the equity in order to sell or take out a HELOC and use that as a down payment on another one and rent out this property. And then suddenly you're an investor. So there's a mindset that you need to be in when you are thinking about buying your first house. And it's not, let me blow everything out right away. You got to think strategically a bit here. Yeah, I mean, that's kind of my plan. Right now, I'm by myself and I'm thinking that I'm wanting to buy a little condo in an up and coming area, and I'll stay in that for 2 to 3 years. And then when I'm ready, I'll be able to buy a little bungalow or buy another house, or who knows where my life is going to be at that point. But I'll be able to take out a HELOC, which is a home equity line of credit. I realized I didn't define that for you. I'll be able to take out a HELOC for the down payment on another house, rent out the condo, boom, I'm an investor. Now that condo is paying for itself, plus putting maybe a couple $100 a month in my pocket. So yeah, that's why I'm saying there's a little bit of a mindset game that you need to play when you're a first-time homeowner. If you're like, Jessica, I don't want to be an investor, that's fine. But the reality is the first home you buy is still probably not going to be your forever home. So just keep that in mind when you're starting this journey. All right, you guys, that is it for this. I know this is a little bit quicker than last week. Next video, I'm going to go a little bit more in depth as far as the differences between an FHA loan and a conventional loan, because this like finance stuff is the tricky part as far as buying a home, and it happens right up front. So I want to try to give you guys as much information so that you can take it and go do your own research and start teaching yourself these kinds of things, so that when it's time to start moving forward in the homeownership, you kind of already have a good groundwork laid. So I hope you enjoyed this. Please like and subscribe. If you have any questions, please email me at homeagain@jessicadorsey.com. Have a great day.